ESG Climate Crisis.
Welcome to the deep dive, where we cut through the noise to get you well informed, fast. Have you ever sort of scratched your head over how a fund can call itself green, but, you know, still be invested in fossil fuels?
Or, yeah, how about when an eco-friendly choice in manufacturing, which
Mhm.
sounds great, right, ends up causing, well, unexpected chaos, like military gear failing because mice like the taste of the insulation.
It's a strange paradox, isn't it?
It really is. That whole intersection of finance, sustainability, and what actually happens on the ground,
Yeah.
it can definitely throw up some surprises.
And that's exactly why we're doing this deep dive. Our mission today is to really unpack the world of environmental, social, and governance investing, ESG. We're zooming in hard on the E, environmental, specifically climate change.
Right.
We want to cut through the jargon, see how financial institutions are actually tackling climate risks and opportunities, and maybe uncover some of those surprising truths behind the headlines.
Yeah, looking at the rules, the strategies, the big questions everyone's grappling with.
Absolutely, because it's huge, isn't it? ESG assets were, what, over $30 trillion globally by 2023?
Massive.
Yeah.
Growth brings debate, lots of it,
Yeah.
especially around greenwashing, those claims that don't quite hold up and just figuring out what sustainable even means.
Okay, so ESG, it feels like it's everywhere now, but it's not brand new. Where did it actually start, and how did climate become such a central part of the financial conversation?
Good question. So ESG is a principle focusing on environmental, social, governance factors in investing. It really got a major push after a UN initiative back in 2004 called Who Cares Wins. That was kind of a turning point.
Who cares wins? Interesting name.
It was, and it
Yeah.
really helped connect finance with these bigger societal goals.
Mhm.
As for climate change, well, it shifted. It went from being just an environmental issue to being seen as a fundamental material financial risk.
Material financial risk. So we're talking dollars and cents, not just polar bears.
Exactly. We usually split it into two main buckets: physical risks and transition risks.
Okay, physical and transition. Can you give us a quick, sort of real world feel for each? How do they actually hit a company's wallet?
Sure. So physical risks are the direct hits from, changing weather. Think bigger storms damaging property, wildfires messing up supply chains, droughts hitting farms. That's tangible damage to assets or operations.
Okay, got it. Direct impacts.
And transition risks. Those come from the shift as economies decarbonize. So think new carbon taxes, maybe technology making old ways obsolete, or just people wanting greener products.
Ah, so like an oil company facing pressure as everyone moves to renewables.
Precisely. Both types can seriously affect how much money a company makes, what it spends, and what its assets are worth. It's very real.
These risks sound, well, pretty significant, but are companies really under pressure to change, or is it still mostly talk? What's driving this globally?
Oh, it's definitely not just talk anymore. There's a pretty strong global agreement now on decarbonization. Think about the Kyoto Protocol and especially the Paris Agreement.
Right, the Paris goals,
Mm,
limiting warming.
exactly. Aiming to keep warming to 1.5 or 2 degrees Celsius.
Mm-hmm.
And you've got major economies setting concrete targets. The EU, UK, Japan, they're all aiming for net zero by 2050. China by 2060. These national goals, they create serious pressure for companies to act.
So it's gone beyond just feeling like the right thing to do. It sounds almost like a legal thing now, part of an investor's actual job.
That's a key shift. A big moment was a 2005 report, the Freshfields Report, for the UN. That report, and then statements from groups like the Principles for Responsible Investment, the PRI, they basically concluded that thinking about ESG issues isn't just allowed for investors, it's arguably part of their fiduciary duty.
Fiduciary duty, meaning their legal obligation to act in the best interest of their clients.
Exactly. Acting in the long-term best interest. So it's moved from being maybe a moral choice to a really practical, even legal consideration for creating value over time.
Okay, let's dive deeper here then. When companies talk about going green, we hear all these terms flying around: carbon neutral, net zero. Do they mean the same thing, or are there, important differences we should be aware of?
That is an excellent question. And honestly, it's where a lot of the confusion and sometimes the deliberate greenwashing happens. They are not interchangeable.
Okay, break it down for us.
So, carbon neutrality is about balancing out CO2 emissions specifically, carbon dioxide. A company might emit CO2, but then invest in, say, planting trees to absorb an equivalent amount. It balances the CO2 book, so to speak.
Right, just CO2. So how is net zero different? Sounds similar.
Net zero emissions is broader, much broader. It's about balancing all greenhouse gases, CO2, yes, but also methane, nitrous oxide, the whole lot, balancing the total amount emitted with the total amount removed from the atmosphere.
Ah, okay, so it's the whole warming picture, not just CO2.
Correct. Yeah. A company going for net zero might use renewables heavily, maybe invest in technology to capture carbon directly. Then you've even got climate positive or carbon negative. That's going beyond zero, actually removing more greenhouse gases than you emit.
Wow, okay, like actively cleaning up the atmosphere.
Kind of, yeah. Maybe through massive investment in things like direct air capture technology.
That distinction is really crucial. So back to this greenwashing you mentioned. How did that become such a big problem?
Well, it really thrived because for a long time, there just weren't clear standardized rules. Terms like ESG or sustainable were used pretty loosely.
So anyone could slap a label on.
Pretty much. It allowed funds to market themselves in ways that maybe didn't fully match what they were actually investing in. And, that led to some investors feeling misled.
And the EU has been trying to clamp down on this, haven't they? What exactly are their new rules?
They have, yeah. Big effort from the EU. The European Securities and Markets Authority, ESMA, brought in new rules around late May 2025. Basically, if a fund has sustainability or environmental in its name, it can't just load up on fossil fuels anymore.
Oh, okay. So stricter naming conventions.
Right. And they had to prove that at least 80% of their investments actually meet the ESG goals they claim.
Okay, so beyond the names and the labels, how do the really serious investors, the ones trying to do this properly, actually weave climate factors into their day-to-day decisions? What strategies are they using?
Right. Moving beyond just the labels, there are established frameworks. A big one is the Principles for Responsible Investment, or PRI. It's UN-backed.
The PRI, okay. What does it actually encourage investors to do?
It pushes them to incorporate ESG issues into their investment analysis, really think about them, to be active owners, engage with the companies they invest in, and to push for better disclosure from those companies. It's about engagement, not just excluding bad companies. Okay, so engagement is key. But once companies are on board, how do they track progress? How do they report this stuff transparently? Is there a standard way?
Yeah, for the reporting side, the Task Force on Climate-Related Financial Disclosures, TCFD, has become pretty much the global benchmark. It helps structure how companies talk about climate risk.
TCFD. Got it. How does it structure things?
It uses four main pillars: governance, strategy, risk management, and metrics and targets.
Can you walk us through those briefly? What does each one mean for a company?
Sure. Governance is about making sure climate is on the board's agenda, that management is responsible, high-level oversight.
Okay, top-down commitment.
Exactly. Strategy means looking ahead, analyzing those physical and transition risks we talked about. Often using scenario analysis like, what happens to our business if warming hits 2 degrees or 3 degrees?
Planning for different futures. Makes sense. Risk management is about having systems to actually identify and manage climate risks across the whole business. Credit risk, operational risk, even reputational risk. There are tools like the Investor Climate Action Plans or ICP Expectations Ladder that help guide this shift from fossil fuels and push for policies aligned with 1.5 degrees.
Right. And the last one, metrics.
Metrics and targets.
Yeah.
This is the measurement part. Tracking specific things like greenhouse gas emissions, scopes 1, 2, and 3.
Scope 1, 2, 3. That's direct emissions, energy use, and supply chain.
Right, the whole footprint. And also tracking what percentage of their assets might be vulnerable to climate risks or maybe aligned with green opportunities.
That sounds incredibly thorough. Are there big companies actually putting all this into practice effectively? Can you give us an example?
Definitely. Swiss Re, the big reinsurance company, is a really good case study. Their whole ESG risk framework is built around this. Their mission is literally make the world more resilient.
Okay, nice mission. How do they translate that into climate action? Net zero goals.
Yep. They're committed to net zero greenhouse gas emissions by 2050 across everything, their insurance, underwriting, and their investments.
Ambitious. How do they decide what to insure or invest in?
They use this idea of double materiality. So they look at how climate change impacts their business, but also how their business impacts the climate. It goes both ways.
Interesting. Double impact.
And they have specific guidelines, like their environmental umbrella guideline. It means they won't back projects that trash biodiversity hotspots, cause massive pollution, or use really inefficient, high-emission technologies.
It sounds like managing all the risks, the data, the engagement must require some serious tools. Is technology playing a big part here?
Oh, definitely. Tech is crucial. We're seeing a lot more use of AI and digital tools. Things like real-time emissions monitoring. You might have heard of Climate Trace, using satellites and AI to track emissions independently.
Satellites tracking emissions. That's cool. What other challenges are there?
Well, there's the tension between long-term goals and short-term markets. ESG benefits often play out over years, decades even. But financial markets, they often live quarter to quarter.
Right. Pressure for quick results.
Exactly. And that can make it hard to justify investments in deep operational changes needed for sustainability if the payoff isn't immediate. It can lead to underestimating the real risks of sticking with unsustainable practices long term.
And what about that wild example we started with, the corn fiber insulation?
Ah, yes. That's a perfect, if slightly bizarre, example of real-world usability compromises. The story goes that some Western arms makers trying to meet ESG guidelines used corn fiber insulation in cables for equipment sent to Ukraine.
Okay. Where is this going?
Well, apparently rodents found the corn fiber insulation quite tasty, leading to damaged cables, equipment malfunctions, an eco-friendly choice unintentionally impacting battlefield readiness.
Rodents eating the wiring because it was eco-friendly, you couldn't make it up? So, with all these complexities, criticisms, strange rodent incidents, what's the future look like for ESG? Is it fading
No.
or evolving?
It's definitely evolving, driven partly by these criticisms. The regulatory landscape is changing fast. We've got new disclosure rules coming online or being developed everywhere. TCFD-based reporting in the UK, the CSRD rules in the EU, SEC proposals in the US,
CSRD?
Corporate Sustainability Reporting Directive, big new rules in Europe for broader ESG reporting. And globally, the International Sustainability Standards Board, the ISSB, is working hard on creating a truly global baseline for standards, trying to bring that consistency and credibility everyone's asking for.
So, the push for better standards and transparency continues.
Absolutely. The market is trying to mature to move beyond just marketing claims.
So, there you have it. ESG, especially around climate change, is clearly a massive defining issue for finance and business. Understanding these dynamics, the frameworks, the real-world impacts, the greenwashing debates, the push for better data, it's really essential for you, our listener, to navigate what's happening in the global economy.
It's definitely a journey, not something with easy answers. The questions certainly aren't going away.
Indeed. Which leaves us with a thought to ponder. Given all this debate about greenwashing and the very real challenges of making finance truly sustainable, how can we, as informed observers, really tell if sustainable investing is leading to actual sustainable impact or just, sustainable marketing?
That's the multi-trillion-dollar question, isn't it? Something to really chew on.
Absolutely. And hopefully it encourages you to keep digging, maybe look into your own investments, check out what companies are actually doing on climate, follow those new regulations as they roll out, and we'll be here ready for the next deep dive.